right, welcome back. You're watching The Money Show with me, Kavita Thapliyal. And capital gains is defined as any profit that is received through the sale of a capital asset. The profit that is received falls under the income category. But all of this can be very confusing for an ordinary investor. The complication increases further when we talk about capital gains tax on inherited property for insurance. On The Money Show today, we will declutter the jargon involved with Divya Baweja, partner Deloitte India. Divya, good evening. Welcome to the show. We are going to talk about various tax implications and tax angles related to your property, your investments, and your gifting specifically. So let's talk about inherited property. For example, I have a property that was bought maybe in 1950s, okay, and where it's inherited property, it's a pass it on property, and one finally sold it off in say 2022. What's the tax implication that's involved over here? What kind of costing and the holding period, cost of acquisition, maintenance, etc., will be counted in when you talk about the tax treatment on this inherited property?
Yeah. So, hi, good evening. So when we look at any of these inherited property, there are a couple of things that need to be borne in mind. One is that when we look at the cost of acquisition, it is the cost of acquisition to the previous owner, as well as when we look at the holding period, if it is inherited, it is the holding period of the previous owner. Now, if any property which has been purchased, say, as you said before, April 2001, what we really need to do is we need to get the fair market value on 1st April 2001, and that becomes the cost of acquisition. And when I then sell it subsequently, we will be able to index it, and the cost of indexation becomes the index cost will be my cost of acquisition. And whatever are the sale proceeds, from there we reduce the indexed cost of acquisition. If there is any cost expenses on transfer, or if there's any cost of improvement, those get reduced. And the balance is my capital gain, which gets offered to tax.
So, Divya, what exactly is the cost of acquisition that's involved over here? How do you evaluate that? How do you also evaluate cost of improvements in a property that's been inherited and it's basically passed it on since so many years?
So, see, cost of acquisition will be your fair market value on
Right.
1st April 2001, because that is something which is important, because if it is a very old property, then you go by the fair market value. So it is that's what the law says. Now the issue is that how do I really do the fair market value? Should I go by the stamp duty value, or should I take the fair market value? So that is where a question arises, and one may want to take some fair market value quotes from registered valuers and see if it is higher than stamp duty value or not. So, but that is how one will need to really calculate my fair market value. So registered valuer could be one option that one can look at. And then the cost of improvements, all that you spend subsequently after the 1st April 2001, is what becomes the basis for calculating the cost, the total cost.
How will you calculate the indexation benefit? Is there an indexation benefit?
Yeah. So indexation benefit is provided. The law, the company the department comes out with the cost inflation index. So every year they'll come out with the cost inflation index. So the cost inflation index of the year in which you are selling it, divided by the cost inflation index in the month of April 2001, multiplied by your fair market value, will give you the index cost. And that will, the basic purpose of doing this cost inflation adjustment is to make sure that, my cost, that looking at the inflation factors, what could have been my cost today, and then you reduce it from the sales proceed. That is how you really calculate the index cost.
What exactly are the technicalities and documents involvement that one should be taking care of, because it's
It's
inherited
an old
property?
property,
Yeah,
right? So
exactly.
what would really help is, one is that obviously you will have your property papers which are there. Then there should be a will or an inheritance deed which is there. And if it is gifted, then you need a gift deed. So these are the documents which one should really have it in your records. and any expenditure that you incur subsequently, say on transfer or any expenditure on improvement, those should be those documentation should be maintained so that in case any audit happens by the revenue authorities, you can substantiate with the help of those documents.
Divya, since you're talking about capital gains, and this is something that we discussed on inherited property, but then let's basically understand capital gains on different type of investment instruments and financial assets that we're talking about.
Right.
What exactly is capital gains, and how can one evaluate that?
So, when we look at different assets which are there, the key thing is that what is the holding period which will define whether an asset is a long-term asset or a short-term asset. Because the capital gain is dependent on whether it's a long-term capital gain or a short-term capital gain. For example, if I look at listed securities or equity-oriented mutual funds, there the period of holding is 12 months. Anything more than that will qualify as a long-term capital gain. When I look at, say, a immovable property, there the period of holding is 24 months. And if I look at unlisted shares, again, the period of holding is 24 months. So one really needs to look at the holding period of these different kind of assets which are prescribed under the tax laws. And depending on that holding period, if you hold the property for a duration which is longer than that, that qualifies as a long-term capital gain. So in case of a, say, specifically inherited property, if it is a very old property, then the law clearly provides that if you are the holding period of the previous owner should be considered into taken into account while calculating while determining the holding period of a property. And therefore, variably, if it was inherited, was purchased by the ancestors, say in 1950 or 1960, and you're selling it now, it is clearly a long-term capital asset. So that is one part. And then there are tax rates which are prescribed for each of these instruments. For example, if I look at an equity share, a listed equity share, if it is held for, as I said, more than 12 months, and if you sell it, then anything above 1 lakhs, you will have to pay a tax of 10% on that. There is no indexation available. Similarly, for any other asset, the rate is 20%. So if I sell an immovable property which has been held for more than 24 months, it will be a long-term capital as gain, and the rate will be 20%. And in case I have equity shares which are listed and which are sold where the period is less than 12 months, then you have, and where there is STT payable, then again you pay a capital gain tax at the rate of 15%. So in nutshell, it is important to determine what is the kind of asset which I hold, what is the period of holding of such asset as prescribed under the tax laws, and then accordingly we determine the tax rate for such gain that arises. Yeah.
Divya, who exactly reports all of this in the income tax return? How do we do that?
So in the income tax return, there's a specific section on capital gains, and the return forms do prescribe that depending on the return, whether it is ITR 2 or ITR 3, depending on where you qualify, you will have to specify the capital gains over there, and there's a separate schedule for that. And it also drills down whether it is a long-term capital gain or is it a short-term capital gain, what is the nature of asset which is there. So you have to fill in those details in the schedule, which forms part of the tax return. Yeah.
We move on and let's talk about financial gifts. So, what kind of financial gifts can be given, and what is the tax treatment if you're getting it from a relative or from a friend?
Yeah. So when we look at these gifts, there is nothing and no embargo under the Income Tax Act that you cannot give a financial gift or you can give a certain kind of gift or you can't give certain kind of gift. There is no embargo under the tax laws. Yes, their tax laws do provide that how will these be taxed in the hands of the donee. So if any gift is given by a person who is not a relative as defined under the tax laws, then typically anything where the value is more than 50,000 gets taxed as in the hands of the donee as income from other sources. So if anything which is given as a gift is less than 50,000, I'm talking about a case where gift is given by a non-relative. where the value is less than 50,000, then it is not taxed. But if it is beyond 50,000, then the entire amount gets taxed in the hands of the donee. And they have also defined who is a relative. And especially in case of relatives, there are exemptions, and relatives have been defined to include, say, person's spouse or linearly ascendant or linear descendant of the individual or the parents. So that is how they have defined who constitutes a relative. And if there are any gifts which are given under inheritance or under the, say, if by a relative on occasion of marriage, so those are exempt. So one really needs to see whether anyone falls as the definition of relative or not, and then consequently the value of the limit of 50,000 doesn't apply if you are a relative, and that is how one needs to see.
All right. I think that will be all. Thank you so much, Divya, being on the show and helping our viewers. Everything related to the financial gifts and capital gains tax included with that. We move on. If you are in your early 20s, this segment is definitely for you. This is the time when you would be thinking of starting your investment journey, but given the sea of options available before you, it might get confusing as to where you should start from. And so today, we will help you chart out your investment strategies. Let's welcome on board Pranjal Kamra, CEO of Analogy Ventures, and take the discussion forward. Pranjal, good evening and welcome to the show. So I'm sure you must be getting a lot of people of this age group, specifically 20-year-old, asking for quick money strategies, quick money-making strategies. So keeping that aside, at that age, you just want to make a quick buck, and it's very difficult to make someone understand the importance of investments, the importance of planning, importance of strategy. A lot of these people, a lot of these youngsters or Gen Zs, might be interested in making money from cryptos or maybe direct stocks, which is fine if it's planned really well. But what are the core investment values that one should be taking care of or considering before stepping into this world of money making?
Thank you for inviting me, Kavita. Good evening. Always a pleasure. I think there's one important understanding, one thought that I want that youngsters should have in their minds. And this one thought will mostly protect them from all the dangers that lurk in the financial market. So when thinking of, making money from money, we need to understand that be it stock market, gold, real estate, any other asset class, investments in these asset classes is step 3 in our financial journey. Step 1 is earning more, step 2 is saving more, and step 3 is then investing more and investing intelligently. What youngsters try to do is they don't want to get into trying to earn more or trying to save more. They just want ki I have 1000 rupees, how can I earn more and more from that? And when we try to do that, we take excessive risks. We need to understand that stock market, gold, real estate, any other asset class can help you defeat inflation, but that's not a substitute for active income. So focus on active income. And we also need to understand from this context that if stock market or any other asset class could have substituted active income sources, then probably I wouldn't be running Phenology. This channel wouldn't be running, the promoters of this channel would be investing in stock market. Mukesh Ambani probably wouldn't be laying fiber optics in the ocean for last 10 years. Everyone would be earning by investing money and making money from money. So making money from money cannot substitute active income. This is one core thought that investors need to know.
What about a planned strategy? Because not everyone starts earning at the age of 20. A lot of people are still saving their pocket money, okay? So how can one go about it?
Right. So yes, sure. I mean, you usually start earning anywhere between 20 to 23, 24 years of age. So if you're not earning at all and all you have is a little savings that you saved from your pocket money and things like that, I think that's actually a great point to start exploring. Because what will happen is when you are a student surviving on pocket money, any money that you lose will actually be money that you would have invested in eating a pizza or going on a weekend party. So there's not a lot of liabilities attached to that money. You don't have a family to answer to. You're not the primary earning member. And that gives you the flexibility to actually experiment. So I wouldn't mind if a youngster with almost zero to no liabilities is investing in stocks, not because he or she will be able to defeat inflation, or defeat the returns offered by mutual funds. Probably that individual will incur losses. But the better part is that individual will learn a lot of things. So, he or she will learn how different industries work, how marketing works, how business model works. So, in terms of alpha, if you measure it through intellectual growth, stock market is a great option. But keeping that apart, in a couple of years, probably someone will start earning. These early 20 students, they will start earning. So how do you go about it once you start earning? And this is really, really important. Step one, the first salary that you get, your first paycheck, whenever you start earning, probably, after giving it to a temple or your parent, or touching their feet and things like that, the first practical thing that you're going to do with your money is buying life insurance. And life insurance is really, really cheap. 500, 600 rupees a month. If you're buying before 25 years of age, for 500, 600 rupees a month, you're getting a term insurance of 1 crore rupees. What's important here is buy term insurance and don't get lured into returns, premium payback, and all those complex plans. Understand you want to save premium.
Pranjal,
and
at
buy
this
the
age, do one really needs a life insurance plan if you don't have any dependence on you financially? This thing can be postponed till the time you really start earning and you have dependence on you?
Oh, absolutely. Once you get your first paycheck, once you start earning, that is when you do this.
Right.
Not as a student.
Right.
Not as a
so just focusing on the investment aspect of it, what kind of financial assets one should be including in their portfolio, or maybe in their strategy, in the money-making strategy, if they want to get into direct equity, which is through stocks, what should be their criteria, and what should be an outlay for making money over there?
Right. So specifically, if you're talking about investing directly in stocks, how you go about doing it is simple. As students or as young professionals, we don't want to make it extremely complex. So one way I do it, I still do it, and one way I think most young people should approach investing is actually tap into companies whose products or services you use as a consumer. So, I often go to large gatherings, seminars, and webinars, and there's a common question that I ask: how many of you use, say, and this is just for example, say a toothbrush, toothpaste manufactured by Colgate, and almost half the hands go up. And then if I ask how many of you actually own the stock of Colgate, and no hand goes up. In investing, specifically youngsters, we think at times that we are investing to generate alpha, but in our minds, sometimes we are investing to become a hero, to sound really intelligent before our friends. And in that quest, we start investing in fancy companies, promising all kinds of innovation, promising to take you to Mars, Jupiter, and things like that. And which is where we go wrong, because we are not focusing on alpha, we are focusing on sounding intelligent. And if you try to sound intelligent, the market punishes you. So in terms of how to pick stocks, please stick to companies that you, your friends, and your families use as consumers. If we take the entire day from morning to evening, I'm sure we use more than 20 companies' products who are listed in the stock market. Stick to that space and then try to filter within that space.
All right. Also, at this particular age, it's very important for you to understand and, in fact, align your important goals in life, This might sound like a gyan for a lot of people, especially of this age group. But then, one has important goals lined up already, which is buying your house and maybe getting married, or maybe sponsoring themselves for a higher education. So, working out a strategy for these particular goals at this age will be a right thing to do. But the question is, how do you go about it?
Right. Oh, absolutely. The first priority should be if you have any kind of debt. So if your family is paying a home loan, or if you are paying, or if you're supposed to pay an education loan once you're a graduate, I think all kinds of investments for, not so necessary goals, which goals can be postponed by a year or two, can wait. But the first focus is, as soon as you start earning, please focus on repaying debt. What we often do is, first I should buy this car, I need this car, I need to go on the holiday and things like that. Everything in balance is important, but number one priority is paying debt. And I think, ultimately, this is really important, that you can't.
Up goals there is a very important thing. Pranjal, I have to stop you for a minute because Bajaj Auto Q4 numbers are out, and let's connect to our colleague Srishti, who's getting you all the details. Srishti?
Well, yes, a great set of numbers coming in from Bajaj Auto this time around. We were expecting a healthy set, if you could say. And this time around, they have surprised on the revenue, EBITDA, as well as the margin front. EBITDA has been recorded at 1,716 crores versus ET now estimate of 1,571 crores. The revenue, the number is coming at 8,904 crores. The estimate was 8,412 crores. And the surprise coming in on margin front as well versus the expectation of 18.7% of the margins. The company clocked in a margins once again over above 19%, and 19.3 is the number. And lastly, onto the profit figure, it was almost in line to what we were expecting. So 14.1 to 1,412 crores was the expectation, and 1,433 crores has been recorded. But let's understand what the analysts make out of the numbers, because the exports still there's something that needs to be done on the export front, which had declined on a sequential basis while the domestic business was supportive. And onto the show, we have Ashwin Patel with us. Hi, very good evening, Ashwin. The first cut on the Bajaj Auto numbers, a surprise coming in on the margin front versus the street estimates. How do you look at this number and the rest of the numbers as well?
Yes, it's a surprise definitely on the margin front, and I think that this should be attributed to the RM costs impact, which definitely comes with a lag, and the steel prices and the other raw material basket, which has fallen in Q1 and Q2, the impact of that has started to seen from Q3, and in Q4 the impact is seen even to a greater extent. Also, I think that the three-wheeler numbers were quite very strong in the last quarter as well as in the previous quarter. So I think the three-wheelers, which are a high margin business, they have also paid and contributed to the margins that the outperformance at the margins that we have seen.
Not mistaken, this 19.3% of the margins is the all-time high levels for Bajaj Auto, because 19.1 was the all-time high that the company told us about in the previous quarter. So do you believe that these set of margins are sustainable given the performance in their international business, and what to make sense for the sector as well, because even TVS Motor has a lot of exposure in the international market. So anything to pick up on these lines?
See, I think that the RM prices, the softening of RM prices, the impact of that will be seen in coming couple of quarters as well. And also I would say that the export markets are expected to be getting bottomed out at this point in time. So in case, because in the last call as well, they had said that maybe like from May, June onwards, we may see some sort of revival in the export numbers. So in case that happens, then definitely we can see a more upside to the margins from current levels. So I think that this is a slow start, a gradual start, I would say, to margins to be seen in a higher territory from these levels.
Do you expect an upgrades coming in on Bajaj Auto, and what's your expectation on the stock price as well, because it's already sitting at its 52-week high levels? So what are the next targets that you should be looking out for, and the stock reaction expected tomorrow?
Yes, I would say that although the stock has shown a 52-week high at this point in time, it can definitely move slightly above from these levels. I need to work on my numbers now, but I think that there can be upgrades given the margin performance and exports expected to get bottomed out, etc. So I think that a good sweet 8 to 10%, at least 10% kind of upside can be seen from these levels, although the stock has shown a 52-week high.
So a 10% upside is still pending probably as per Ashwin, but with this we let you go on that. Ashwin, thank you so much for joining us today on ET Now. So that was all about Bajaj Auto's Q4 FY23 earnings, a good set coming in, the surprise coming in on margin, revenue as well as EBITDA front, although the profit was in line and the company clocked in 19.3% of EBITDA margins and even getting a thumbs up from the analyst as well. Back to you, Kavita.
Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market and through which you can invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Hemant Ustigi, Wise Invest Private Limited. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Hemant, and welcome to the show. We have first question for you from Mr. Damodar, and he says that he wants to achieve a corpus of 3 crores and his time of investment or time horizon is 15 to 20 years. He has certain funds in his portfolio, which is PGIM India Mid Cap Opportunity, ICICI Pru Nifty Next 50, SBI Small Cap. He wants to understand if he can hold on to these funds and how much would be the investment amount that needs to raise.
Good evening, Kavita. I think if you look at his corpus that he wants to build up, basically his current investment is around 10,000 per month through SIP. He needs to actually invest in all 31,000 rupees. So basically he needs to add his SIP of around 21,000 to what he's doing currently to accumulate the corpus that he intends to do after completion of his time horizon. There are 3 funds in his portfolio. There is one mid-cap fund, there is a small-cap fund, and there is basically a passive fund, index fund, which is Nifty Next 50. My advice would be that, yes, it makes sense to have maybe a passive fund in the portfolio, but it would be better that to create the kind of balance that you require in the portfolio, that even if you're looking at large cap, it will be better that if you can look at Nifty 50 instead of Next 50. So I think one change for the current investment, but like I mentioned, he needs to increase his SIP by 21,000, and that he should try and do as soon as possible, because if it takes more time to do that, he will obviously have to increase his SIP amount over a period of time.
What about the fund selection?
Sorry, Kavita?
What about the fund selection?
Well, he already has 3 funds. One, like I said, one large cap, mid cap, small cap. He can add to that. But it all depends on, how much he wants to increase and whether he's going to do it immediately or after some time. But definitely he can increase. There is a scope to increase investment in the current 3 funds. If he needs to maybe add 1 or 2 more funds, then my recommendation would be to look at a large and mid-cap fund. My 2 recommendations would be there. One is ICICI large and mid-cap or HDFC large and mid-cap. So one of those 2 funds that can be included in the portfolio.
Why do you think a large and a mid-cap category would be good for his portfolio? I mean, can he add like a Flexi Cap as well? Is it possible?
Yeah, he can. See, what happens is, if you look at a Flexi Cap, the fund manager has the flexibility to decide, how much would be allocated to each of the market segment. But invariably, what we have seen is, if you really analyze the portfolio of most of the Flexi Cap funds, you will find that there's a bias, a very strong bias, in fact, towards the large cap. So what typically happens is that maybe around 70-80% will go into large cap. So that's exactly the reason why I was saying that if you go into large and mid, then you know that at least 35% will be invested in each of these segments. There again, you will see the bias for the large cap, but it won't be not as much as what you usually will find in the Flexi Cap.
All right. Now, what happens is when we talk about diversification, and especially if you talk about having a large cap tilted portfolio, one definitely needs to keep in mind, if you have a specific large cap fund, if you have a flexi cap, and if you have a large and a mid cap. Do you think exposure in large cap, because large cap is a category where a fund manager cannot really experiment much, but instead of that, a mid cap and small cap or even a flexi cap, you can have variations. You can have like a large cap cap tilted flexi cap. You can have a mid and small cap tilted flexi cap. So how can one play that strategy where they can have a restricted exposure to large cap, so that looking at the kind of performance, the entire portfolio doesn't have to suffer?
See, there are two things that one can look at. If you really are concerned about that, you don't want your portfolio to be having a heavy bias towards the large cap. There is a category called multi-cap. Now, multi-cap means there is a minimum investment that has to be made in all the three segments, which is like say 25%. Now, what happens there is that even though you may find that even in the multi-cap, the exposure to a large cap would be more than the rest of the other two segments, but it won't be that much higher as you would find in a flexi cap fund. Second is, like I mentioned again, there is a possibility, of course, you can create a portfolio by looking at large cap, mid cap, and small cap and invest separately in these. But then what happens is rebalancing becomes a problem. As an investor, you'll not know really when to kind of rebalance, or even taxation can be an issue. So that's the reason why I usually recommend that you look at large and mid cap. Because in those kind of fund, you see maybe 60% will be in large cap and 40% will be in mid cap. So you can maybe still have the bias towards the large cap, but it won't be, like I said earlier, as high as you would usually find in a flexi cap.
All right, we move on to our next viewer, Lakshmi Menon from Bangalore. She's on phone line with us. Hi, good evening, ma'am. How are you doing?
Good.
Thank you so much for sending us your portfolio. So just cross-checking your funds, you will be, you want to save up for your retirement for next 15 years, and currently you have Parag Parikh Flexi Cap, PGIM India Flexi Cap, ICICI Pru Nasdaq 100, PGIM Mid Cap Opportunity, Quant Mid Cap, Nippon Small Cap and Quant Small Cap. Are you consulting a financial planner?
I am the financial planner, but right now my husband is not there. After that, he will come. You can call me.
All right. So maybe he can watch our show again in the night, when we have a retelecast. But then, Hemant, what do you have to think about the strategy? Also, I'm not sure about the corpus, which is not mentioned how much they would be wanting to accumulate for retirement goal. But then, how are the funds? Too much of repetition and over diversification in certain categories?
Well, I think two important aspects here. Looking at the time horizon, it is absolutely important to build a portfolio which has the potential to kind of keep you stay ahead of inflation, which is what I think the equity portfolio will do. I think in that sense, she has done well. She's built a portfolio of equity funds. There are a couple of changes I think that would be required. One, my recommendation would be that there is a PGIM Flexi Cap fund. We just discussed that. My recommendation again would be that instead of that, go for a large and mid cap fund. I mentioned about two funds earlier, ICICI large and mid cap fund or HDFC large and mid cap fund. One of the funds can be looked at. Then I see that there are two mid cap and two small cap funds. The issue is with the small cap, there are no, because if you really see in the small cap, the most important thing is the quality of the portfolio and how aggressive the portfolio is. Normally, you will see when you analyze the portfolio of small cap funds, you'll find a number of stocks exactly for this reason, because there are issues of liquidity, and obviously you want diversification level to be higher as compared to other category of fund. But I would recommend that maybe look at one small cap fund here instead of two. So there is Nippon and there is Quant. Maybe she can continue with Nippon, and the money which is being invested in Quant can also be added to this. So in terms of segment exposure, which will be around 20% of the overall investment, that is fine, but keep one fund in that category. And second, as I mentioned, instead of the flexi cap fund, go in for a large and mid cap.
Thank you so much, Lakshmi, for the question. And you will be getting, just in case you want to know the timings, 10 p.m. tonight, again, you can watch the show, or else this show goes on our channel's YouTube also. Maybe you can get the fund's name and suggestion made by Hemant over there. We move on. Let's take Sunny Chadda's question, Hemant. And so he is doing SIPs in UTI Nifty Index Fund, UTI Nifty Next 50, Sundaram Large and Mid Cap. He also has Kotak Emerging Equity, Axis Small Cap, Motilal Oswal Nasdaq 100, DSP Healthcare Fund. And he wants to keep up with these SIPs for more 5 to 7 years. And he wants you to review his funds, and also if he needs to switch or rebalance his portfolio towards any specific category. So, yeah. A lot of repetition and a sector fund.
Yes, Kavita, I think two important aspects here. One is that portfolio has a mix of active as well as passive funds. which I think is a good strategy. It's always, if you're looking at indexing a part of your portfolio, you can do that. Now, the issue here is that there are two index funds I can see. One is the Nifty 50 and the second one is the Nifty Next 50. And in both, the amount invested is equal, which is 9,000 I think, in both these funds. The issue is that while I totally agree that you can index a part of your portfolio, but you need to be very selective in terms of which funds are you investing in. Now, when you're investing equal amount in both these funds, which practically means that you are actually investing in every single stock that is a part of the large cap universe, which I don't think is a great strategy. So for him, my recommendation would be that he can continue investing in the Nifty 50 fund, but in place of Next 50, UTR Next 50, I would recommend having an actively managed large cap fund, which is Nippon India Large Cap Fund. If you really look at how this fund has performed consistently, it has outperformed the index, it has outperformed the peer group. I think it's a very good addition in the portfolio. So I think one change would be that. Second is in the large and mid cap universe, there are better funds than Sundaram. Two funds I've already discussed in the show. I think one of those funds I think would be definitely a better option. Third is you having a healthcare fund. It's sometimes you get tempted to include a sector fund thinking that if I made my portfolio slightly more aggressive, I can get higher return. But there are issues of how you manage that part of your portfolio. You need to be very sure about your timing, when to enter, when to exit. So for anyone who doesn't have a large portfolio, who's not very experienced, doesn't have the wherewithal to know what is the entry and exit point, my recommendation always is to go for diversified fund. One fund that we are making change here in terms of large and mid, I think there is a scope to increase allocation to that. So the money which is being invested in the DSP healthcare fund, that can be added to the large and mid cap fund. So a couple of changes in the portfolio, important because he has another 5 to 7 years. So he doesn't really have a very long-term horizon from here on. So he need to really create the right balance where the exposure to different market segments is in such a way that there are no unmonitored risk in the portfolio.
All right, so that's the recommendation coming for Sunny Chadda. We don't have him on the phone line, or else we could have dived deeper in his question. But then let's move on. And let's take Azruddin from Qatar, his question, and he's invested in UTI Nifty 50 Index, SBI Contra Fund, Mirasit Tax Saver, Parag Parikh Flexi Cap, Quant Mid Cap, PGIM India Mid Cap, and Quant Small Cap, Canara Bank Small Cap, Tata Small Cap, and his corpus is 2 crore plus. He'll be investing for 15 to 20 years more for children education and marriage, and he also, his plans are all direct plans, that's what he writes, and he wants an investment strategy or a portfolio where he can beat inflation in the long term, and which is why specifically he says that he's picked up small cap funds, and he can do more SIPs of 20,000, 27,000 per month, and he has just started investing in March 23. So a lot of exposure in small cap, is that really helpful, or is just making your portfolio more risky?
Well, Kavita, let me address that issue. He mentioned that his intention is to stay ahead of inflation or beat inflation. Obviously, look, when you're investing in a portfolio of equity funds over the next 15, 20 years, you will definitely beat inflation. You don't have to really make your portfolio so aggressive to beat inflation. So I think there is a need for him to make a change in his strategy there. If you see in the current investment out of 20,500, almost 13,500 is being invested in small cap fund. Yes, these funds do have the potential to perform better than the other segments for the longer term. But then one need to really understand that there has to be always a balance between risk and reward. It can make portfolio very, very aggressive. So my recommendation would be that he should be looking at only one small cap fund, which is Canara Robeco Small Cap Fund. And the money which is being invested in the remaining two small cap fund can be actually reallocated to some of the existing fund. For example, there is a Parag Parikh Flexi Cap Fund. Now, this fund obviously predominantly invests in large cap, that there is some exposure to mid cap, and then there is also exposure to US stocks around 17%. I think that increasing allocation to that. Second, there is also index fund, UTI Nifty 50 index fund. So 4,500 can be added to that. So like I mentioned earlier, if you are trying to create a portfolio mix of actively managed fund and the passively managed fund, then the allocation has to be right. So I think this is the changes that he needs to make in his portfolio.
All right. Now, looking at the incremental amount, he should be investing in the same funds?
Well, I think he's right. Currently investing around 20,500. He mentioned that he can overall invest around 27,000. I'm not too sure whether he wants to add 27,000. So there is remaining 77,000 that he needs to add. He can definitely look at existing funds to add this amount.
All right, we move on and let's take G. Rameshwar Reddy's question. He is 72 years old and he holds 45,000 in HDFC World Index International Fund for at least 2 years and 4.5 lakh investments so far, and he's not happy with the returns. So what do you suggest? What kind of a fund is this first? What kind of a fund is this?
Well, yes, I think this is a fund. Basically, it's HDFC World Index International Fund that he's mentioning. His actual name is HDFC Developed World Index, which is actually a fund of fund and it invests in index and the ETF that correspond to MSCI World Index. So practically, if you look at the composition of this portfolio right now, around 66% of the money is invested in US market, around 19% is invested in European markets, and the remaining in the rest of the markets. So, you can see that it's a good spread in terms of allocation to different international markets. I strongly believe that there is always a very strong case to have at least one fund where you have exposure to international markets, because geographical diversification in the portfolio is absolutely important. Most of the time, we focus on having different asset classes in the domestic market. And of course, within that equity, for example, we look at different exposure to different segments in the market. But I think having exposure to international market, I think is important. But it's very important also to see the quantum of exposure. If you're a new investor, don't very aggressively invest in these funds. Maybe you can begin with 5%, go up to 10%. But I think it's important to have this. Now, he said he's not very happy with the performance. Look, this is not a very old fund. I think it's around 18 months old fund. And we have seen in the last 12 to 15 months how all the markets have been impacted for various reasons. So obviously, if those markets have been volatile, the returns have not been that good, that will also reflect in the performance of this fund itself. But I believe that it's a good fund. He needs to really give it time. He should not be judging this fund based on the performance of the last 1 year or 15 months.
All right. We don't have him on the phone line, otherwise we could have asked about his rest of his portfolio. Looking at his age, which is 72, we would really want to see how he's planned his retirement. But let's move on and let's take Gopi Raju's question. He's from Chennai and he's been doing SIPs in almost 7 mutual funds since 2018, ICICI Large and Mid Cap Fund. L&T Mid Cap Fund, he has Sundaram Consumption Fund, whereas at Large Cap, he also has ICICI Pru Banking and FinServ Fund. He has Axis Blue Chip and Aditya Birla Digital India Fund. And he wants you to review his portfolio. A lot of sector allocation, don't you think so?
Yes, there is. There's a consumption fund, but I think he has discontinued that. There's a digital fund. We mentioned this issue earlier in the show, that for any investor who is not really very experienced, there is no need to actually look at sector fund. Let's not forget that if there is a sector that has a potential, and if the fund that you're invested in has been consistently performing better than the average of what of the category gives, which means that the exposure to sector also has been well taken care of, which means that if there is potential in a certain sector during a certain phase, the fund manager will ensure that your fund has a reasonable exposure to that. You don't really have to kind of go into a sector fund yourself. I think that's important for every mutual fund investor to understand, that when you give money to a professional fund manager, you allow him to take decision or her to take decision on your behalf. Many a times we try to replicate what the fund manager is doing. I think that it defeats the very purpose of handing over your money to a professional fund. So my advice always is that to stay away from sector fund unless you are a hardcore equity investor, you are a very experienced investor, you are comfortable, you know exactly when to enter or when to exit, and you're okay with a higher level of risk. in the portfolio, then you can look at it. But I think for a common investor, I don't think it really makes a lot of sense to look at a sector fund. So I think definitely there is a need to kind of make a couple of changes in the portfolio. As I mentioned earlier in the show, that to create the balance between risk and reward.
All right. Now, even if one wants to diversify their portfolio by adding a sector fund, what should be the criteria? Looking at the current scenario, what sector do you think really makes sense to have in your portfolio?
Well, I think one sector that definitely I feel that has the potential to do well, has started doing well, has been doing well, in fact, is the banking sector. But the issue is, again, that if you analyze the portfolio of any flexi cap fund or any large cap fund, you will find that around 30-35% exposure already to this sector, which again is an important aspect for investors to look at. IT as a sector has been doing very well, hasn't done well, and maybe it will take some more time to perform well from here. Again, even in terms of pharma, if you see, there was a time, couple of years, the pharma fund did very well, but in the last year or so, they have not done as well. The point is that there can be certain sector, for example, in between we saw that in the thematic fund, the infrastructure funds did very well. That's exactly the point I was trying to make, is that the timing has to be right and the selection has to be right. And whenever you want to look at a sector fund, I think it's important to analyze your overall portfolio and see what is exposed.
Right. I think that will be all for today. We are running out of time, but Hemant, thank you so much for being on the show and helping our viewers with their financial portfolios. And on that note, I sign off with leaving you with our WhatsApp number and email ID where you can reach us with your financial portfolio queries. Thank you so much for watching. Goodbye.